If you've ever tried applying for a credit card and felt overwhelmed by terms like secured and unsecured, you're not alone. These two categories of credit cards may seem similar on the surface, but they serve very different purposes, and knowing the difference could be the key to building or rebuilding your credit the smart way. Whether you're just starting your credit journey, recovering from a financial setback, or trying to figure out which type of card fits your goals best, understanding how secured and unsecured credit cards work will give you the power to choose the right financial path forward. In this video, we're going to break everything down for you in a simple, easy-to-follow way. So you won't just understand the difference. You'll know exactly which one to pick, how to use it wisely, and how it can affect your credit score and financial future. So make sure you stick around till the very end, because by the time you're done watching, you'll be ready to apply for the card that truly supports your financial growth. And if you find this video helpful, don't forget to hit that like button, subscribe to the channel, and tap the bell so you never miss powerful insights that make money simple. Let's clear up the confusion and dive right in. When people think of credit cards, they often imagine sleek plastic that lets them buy now and pay later. But what most beginners don't realize is that not all credit cards are built the same. In fact, when you're trying to build or repair your credit, the kind of card you start with can make a huge difference, especially if you're choosing between a secured credit card and an unsecured credit card. At their core, both types serve the same fundamental purpose. They allow you to borrow money from a lender to make purchases with the expectation that you'll repay it, ideally in full and on time. But the way you get approved, the way your limit is determined, and the risks and benefits involved are dramatically different. A secured credit card is specifically designed for people who are either brand new to credit or who have low or damaged credit scores. What makes it secured is the deposit. When you apply for a secured card, the issuer requires a refundable security deposit that typically becomes your credit limit. If you deposit $300, your limit is usually $300. This deposit protects the bank because if you default, they can use your deposit to cover the balance. But from your perspective, you're essentially borrowing against your own money while getting all the reporting benefits of a regular credit card. This is why secured cards are one of the most powerful tools for credit building. Every month you make on-time payments, that history gets reported to the major credit bureaus, Experian, Equifax, and TransUnion, which helps build or repair your credit score over time. Now, an unsecured credit card is the more traditional kind you're probably used to hearing about. There's no deposit required. The issuer extends a line of credit based on your creditworthiness, which is determined by your credit score, income, and debt-to-income ratio. The risk is higher for the lender, which is why people with better credit get approved for higher limits, lower interest rates, and better rewards. But for those with limited or poor credit, approval can be tough. And this is where the secured card becomes your stepping stone. Many people get frustrated when they apply for an unsecured card and get denied. What they often don't know is that they could get approved for a secured card and use that to build their score and later graduate to an unsecured card with better benefits. So the secured card is not a permanent tool. It's a bridge to something better. One major difference between the two is the approval process. With a secured credit card, your credit score matters less. In many cases, people with no credit or scores under 600 can get approved, as long as they can provide the deposit and meet basic income requirements. For unsecured cards, especially the ones with low APRs or high rewards, a good to excellent credit score, typically 670 and above, is often required. That's why secured cards are often recommended for students, recent immigrants, or anyone who's had past delinquencies and wants to start over. Another key difference is how your credit limit is determined. With a secured card, it's usually equal to the deposit. Some issuers might give you a slightly higher limit than your deposit, but that's rare at the entry level. With unsecured cards, your limit is based on your credit profile. You might get a $500 limit as a beginner, or $10,000 if you have strong credit. And over time, with good behavior, your unsecured card issuer may raise your limit without requiring any additional deposit. But the real power of both cards comes from how they affect your credit. Both secured and unsecured cards can help you build a strong credit profile if used responsibly. This means making on